Okay, let's unpack this. We are diving into a fiscal policy move that is, well, staggering in scale,
Truly.
even by the standards of one of the world's largest and most sophisticated economies.
Absolutely.
Japan's cabinet has just greenlit a truly colossal economic stimulus package.
Yeah.
We're talking 20 trillion.
And that number, 20 trillion, it really needs to be immediately contextualized.
It's hard to even wrap your head around.
It is. So for you, the listener, tracking this in US dollars, that translates to approximately $135 billion USD.
135 billion.
And to put that magnitude into perspective, this single stimulus package is larger than the entire GDP of countries like, say, Ukraine or Kuwait.
Wow.
It is a massive, deliberate injection of public funds into the economy.
Absolutely. And when a figure that large hits the wire, it tells you two things simultaneously. One, the government recognizes it's facing some serious interconnected systemic
Problems, yeah.
And two, it is betting its entire economic future on the successful execution of this response.
It really is.
So we have to view this not just as, a financial announcement. This is a high-stakes strategic gamble.
That phrase, strategic gamble, is absolutely key here. The immediate goal is, on the surface, pretty obvious.
Right.
To address a very complex web of domestic economic challenges. Most urgently, the sudden rise in living costs and these inflationary pressures that are hitting households so hard.
And hitting them for the first time in a generation, really.
For the first time in a very long time. But, and this is crucial, the spending is dual purpose.
Okay.
It simultaneously attempts to lay down the tracks for long-term growth and enhanced global competitiveness in areas where Japan sees its future.
But the magnitude of this number, combined with, let's say, the context of Japan's finances, is why financial markets are doing more than just anticipating a short-term boost.
They're nervous.
They are, frankly, fretting. And this notable apprehension is the core conflict we really have to dissect today.
Precisely. The shadow hanging over this entire conversation is Japan's long-standing and absolutely enormous national debt.
The elephant in the room? Or maybe the Godzilla in the room.
A very large elephant, yes. It's already the highest debt-to-GDP ratio in the developed world by a lot.
And it's not even close.
Not even close. So adding another 20 trillion to that burden raises critical, almost existential questions about Japan's fiscal sustainability.
I see.
So our mission today is to unpack where this massive sum is going, the long-term strategic intentions driving the investments, and the really technical reasons why this level of spending creates such anxiety among global investors.
Okay, let's start at ground zero then. The immediate rationale. Why this specific move and why right now?
Right.
Because when we think of the Japanese economy over the last, 30 years, the global narrative has centered on the lost decades.
Yes, the deflation story.
Deflation, stagnation, risk aversion. That's the Japan story we all know. So why are we suddenly talking about an aggressive stimulus aimed at controlling inflation?
It's a complete economic whiplash, as you said. For years, Japan was the unique outlier.
The exception to every rule.
Exactly. Plagued by persistent, deeply entrenched deflationary pressures, which discouraged both spending and investment.
Because why buy today if it might be cheaper tomorrow?
That was the mindset. It became ingrained in the national psyche. But that dynamic has changed, and has changed abruptly over the last couple of years.
What specifically caused that change? I mean, is it purely a surge in domestic demand, or are we seeing global factors at play here?
It's primarily global factors intersecting with domestic policy. You have to look outside Japan first.
Oh.
We're talking about massive import price inflation. This is due to global commodity shocks, especially energy and food prices going through the roof.
The same pressures everyone's feeling.
The same ones, but amplified. And crucially, amplified by a weakened yen, particularly relative to the US dollar.
And that's a huge deal for Japan.
It's a massive deal. Because Japan imports much of its fuel and raw materials, that weak yen makes everything dramatically more expensive.
So every barrel of oil, every shipment of grain costs more yen than it did a year ago.
Substantially more. This inflation intensity, as some are calling it, is rising very rapidly, and it's just eroding purchasing power.
And it must be hitting families who haven't seen a real pay raise in years.
Exactly. It's especially painful for those who have seen negligible wage growth over the last 2 decades. Their costs are up, but their income is flat.
So the government is cornered. They have this long-term systemic ailment, the need to counteract decades of stagnation and stimulate dormant domestic demand.
The ghost of the lost decades.
And then they have the immediate acute pain of this new inflation squeezing the average family. It's a policy nightmare.
It truly is. You're trying to solve two opposite problems at the same time.
So how does this package try to do that?
Therefore, the R20 trillion package is designed with two immediate and potentially conflicting targets that have to be managed simultaneously.
Okay, what's the first one?
First, it's fighting that structural deflationary mindset. It's trying to stimulate broad domestic demand, aiming to finally ignite what economists call the virtuous cycle.
Let's break down that term, the virtuous cycle, for our listeners. What does success actually look like here? What's the dream scenario?
The dream scenario is a self-sustaining upward economic spiral.
Okay.
The stimulus puts money in consumers' hands and offers incentives to businesses. Consumers, feeling a bit more secure, spend more, which boosts demand.
And businesses see that demand picking up.
Right, so they start to increase production capacity, they invest in new equipment, new factories, that's capital expenditure.
And to do that, they need more people.
To do that, they must hire more people and, crucially, raise wages to attract and retain talent.
And there's the key.
That's the key. Higher wages, in turn, lead to even higher consumer spending, and the cycle continues, hopefully, without constant government subsidy.
So this package is an attempt to break the psychological anchor of low expectations that has characterized Japan for so long.
It's a shock to the system, designed to change behavior.
And second, as you mentioned, they are mitigating the pain of the current painful inflation.
Exactly. It's mitigating the symptom while trying to cure the disease.
A difficult balancing act.
Very. And if we look at the allocation of the funds, the first major pillar addresses that immediate pain point: direct household support.
Putting money back in people's pockets.
A substantial portion is earmarked for these financial cushions, basically ensuring that rising utility and food bills don't completely cripple lower and middle-income families.
And how is that direct support structured? I mean, is it just straight cash handouts, a check in the mail, or is the government trying to be more strategic about where that money flows?
The source material suggests it's a multifaceted approach. It's not just one thing. It incorporates direct aid, yes, but also specific subsidies and strategically targeted tax breaks.
So not one size fits all.
Not at all. It's often not a universal cash handout, but more targeted measures. For instance, you might see energy subsidies aimed at reducing utility costs directly at the source.
So your electricity bill is just lower.
Exactly. Or tax reductions that specifically favor lower-income earners or families with children. The rationale is highly pragmatic.
Which is?
You have to maintain a viable baseline level of consumer spending. If inflation causes consumption to fall off a cliff, their entire attempt to fight deflation fails immediately.
And you risk a much deeper recessionary spiral.
You do. They need people spending, not hoarding out of necessity or fear.
Okay, that makes sense. So that's the household side. What about the business side of this immediate relief?
Right. So the second crucial allocation area is support for small and medium-sized enterprises, the SMEs.
It's easy to focus on the big names, Sony or Toyota.
Everyone does.
But we have to emphasize just how vital this SME sector is to the foundational strength of the Japanese economy, especially outside of Tokyo.
It's everything. The health of the SMEs really determines the health of the entire workforce.
So why is such a specific focus on them when, global competitiveness often rests with the largest firms?
Because they constitute the vast, vast majority of Japan's employment landscape. They are the crucial cogs in the supply chains of the larger manufacturers.
So Toyota doesn't build a car in a vacuum?
Not at all. It relies on hundreds of smaller companies providing everything from screws to seat fabrics to specialized electronics. And these SMEs support vital regional economies.
So widespread SME failure would be catastrophic.
It would trigger mass layoffs, which immediately crushes that virtuous cycle the government is trying so desperately to initiate, and it creates social instability.
So the support here, things like grants, low-interest loans, tax incentives, this is essentially a financial stabilization measure. It's about preventing mass failure and unemployment.
It's a cushion. It's designed to help them weather the dual storms of, 1, high input costs, their energy and materials are more expensive too, and 2, potential demand sluggishness from those squeezed households.
It's preventing a domino effect.
Precisely. So when you look at this first part of the package, it's pure economic first aid.
Stabilize the patient.
Stabilize household finances and stabilize employment via the SMEs. But, and this is the important part, if that was all this package was, it would simply be expensive, temporary relief.
Right, a very expensive Band-Aid. And that takes us to the real strategic core of the gamble.
Exactly. If we look beyond the temporary demand injection, the policymakers are making it very clear.
This isn't just about getting to the winter.
No, this is a multi-pronged strategy designed not just to survive the current headwinds, but to create a structurally more resilient, more dynamic economy for the long run.
So they recognize they can't simply print their way out of a 30-year stagnation period.
They've tried that before in different ways. It didn't work.
So this means we're transitioning from short-term relief, or what we call demand-side stimulus,
Yes.
to a calculated attempt at supply-side transformation.
Hmm.
This is about pivoting Japan's entire economic identity for the next generation.
That's a perfect way to put it. The third major component, and this is where the money is a calculated bet, is targeted strategic investments.
Not just general spending.
No, not at all. It's focusing on sectors deemed absolutely critical for future economic prosperity and, frankly, for global relevance. This is a very different approach than past generalized spending.
Okay, let's dedicate some serious time to these areas, because this is where we see Japan's explicit statement of intent. This is where they believe the next wave of productivity and exports will come from.
It's their roadmap.
We have 4 core areas outlined here: advanced technology, artificial intelligence, renewable energy, and digital transformation.
Let's start with advanced technology. This often means strategic manufacturing capabilities.
Semiconductors come to mind immediately.
That's the big one. Given the global geopolitical focus on secure supply chains, particularly for chips, Japan is doubling down on its sophisticated manufacturing legacy.
They have a history of excellence there.
An incredible history. So this investment is aimed at subsidizing new facilities, R&D, and the production of high-value components that sit at the very top of the global supply chain.
So they're not trying to compete on making cheap, basic chips.
No, they're aiming for technological sovereignty and global leadership in key advanced components, not just mass production. They want to be indispensable.
And this ties directly into the second area you mentioned, artificial intelligence.
Mhm.
AI is defining the future of, well, virtually every sector, from robotics to finance.
It is.
What specific ambitions does Japan have here?
Japan is acutely, painfully aware that its workforce is shrinking due to demographic.
The aging population.
The aging population, the low birth rate. So AI and advanced robotics are therefore seen as a necessity, not a luxury, to maintain productivity.
It's an answer to a demographic problem.
It is. So the investment here targets both foundational AI research developing next-generation models and the massive integration of AI into traditional Japanese strengths,
Like what?
like industrial automation and healthcare systems. The goal is to maximize the output of a smaller workforce and maintain a technological edge against competitors in the US, Europe, and Asia.
So it's a demographic imperative masquerading as a technological
A
investment.
very apt description.
Now, the third area, renewable energy, or the green energy transition, is also a massive global shift.
And this is critical for Japan for both resilience and competition. Remember, Japan is highly reliant on energy imports.
Which is what's fueling their domestic inflation problem right now.
Exactly. So investing heavily in renewable energy infrastructure, solar, offshore wind, next generation battery technology, it solves 2 problems at once.
Okay, what are they?
1, it reduces their geopolitical risk by increasing energy self-sufficiency. They become less vulnerable to shocks in global oil and gas markets.
And 2,
2, it creates a massive new domestic industrial sector that is capable of future exports.
so they can sell this green tech to the rest of the world.
Precisely. This investment signals a commitment to becoming a leader in the global energy transition, especially through things like green hydrogen or advanced geothermal solutions, given Japan's unique geography.
And finally, digital transformation, or DX. This seems like the broadest category. How are they channeling funds into this?
DX is about modernizing the entire economic operating system.
That sounds ambitious.
It is. It's particularly focused on government services, financial systems, and most importantly, those SMEs we discussed earlier.
I heard stories about this.
Many smaller Japanese businesses still rely on incredibly outdated processes. We're talking sometimes even paper ledgers or fax machines.
Still using fax machines in 2025.
It's more common than you'd think. So the investment here is in creating digital infrastructure, cybersecurity measures, and subsidizing the adoption of cloud services and modern software tools across the entire economy.
So it's about boosting overall productivity and making businesses nimbler.
That's the goal.
That 4-pronged approach.
Mhm.
It is entirely a calculated bet. It's an attempt to buy a future productivity, to move the economy beyond the limits of its traditional legacy manufacturing base.
And this strategic focus is what distinguishes it so fundamentally from past interventions.
Right.
Japan has a well-documented and frankly somewhat depressing history of using massive fiscal stimulus for decades.
Going back to the 90s.
Going back to the 90s and the early 2000s, back then, the bulk of spending went into generalized infrastructure projects.
We often heard the criticisms about those projects, the famous bridges to nowhere.
Exactly. Those past measures were often criticized as political pork. They were generalized attempts to simply prop up the construction industry and keep employment ticking over.
And the result.
The result was often infrastructure that wasn't strategically necessary or economically productive in the long run. They treated the symptoms of low demand, but completely failed to fix the structural issues of low growth.
So if past stimulus was generalized and infrastructure heavy, how does this 20 trillion package represent a genuine strategic pivot? It's not just more of the same.
The difference lies in the surgical focus and the explicit link to future technological growth areas.
It's targeted.
It's highly targeted. Past efforts were cyclical. They were trying to smooth out a downturn. This one is structural. It's trying to change the very nature of the economy. By specifically targeting AI, green energy, and digital transformation, the government is trying to force capital into high-growth, future-proof sectors.
So it's not just about creating jobs, but creating a specific kind of job.
High-skilled, high-wage jobs. It suggests an acknowledgement that purely traditional Keynesian spending, just building roads and bridges, failed to break the deflationary cycle.
So they're trying to create the next generation of industrial leaders and competitive exports, rather than just waiting for the last generation to recover.
That's the gamble. It sounds like an admission that structural problems require targeted structural investment, even if that carries greater risk.
It's an attempt to create a resilient ecosystem that actively adapts to future global challenges, rather than just passively reacting to slow growth.
This all sounds incredibly ambitious and, frankly, necessary. But now we have to address the financial reality that makes global investors extremely nervous.
The other side of the coin. Market apprehension and the shadow of Japan's debt. When this news broke, the term lavish was used by a lot of sophisticated financial analysts. Why lavish? What does that descriptor tell us about the market's underlying concern?
Lavish in this context is a very diplomatic, very careful way of saying we are seriously questioning Japan's fiscal prudence.
They think it's reckless.
They're concerned it might be. It reflects genuine market worry because this package is being deployed on top of a foundational financial issue that is globally unprecedented for a major developed economy.
And that is the debt reality. Can we define the true scale of this debt in relatable terms for the listener? Just how bad is it?
Absolutely. Japan's national debt to GDP ratio currently stands at well over 250%.
250%.
Let that sink in.
Yeah.
That means its national debt is 2.5 times the size of its entire annual economic output.
That's just mind-boggling.
If we put it in the stark terms of individual contribution, and this is just a conceptual exercise, of course, if every citizen in Japan were instantly required to pay off this public debt, each person, from a newborn baby to a centenarian, would owe millions and millions of yen.
So adding another 20 trillion to this enormous burden understandably sets off major alarm bells globally.
Major alarms.
Now, here's where we need to get a bit technical for our informed listeners, because this is the big question.
Right.
Historically, Japan has gotten away with this astronomically high debt load without a sovereign debt crisis, unlike, say, Greece or Italy during the Euro crisis.
A very important point.
Why is Japan's situation unique? And more importantly, is that uniqueness sustainable?
This is the crucial point that investors and economists are always debating. Japan's debt is unique for two main reasons.
Okay, what's the first?
First, it is almost entirely held domestically.
Not by foreign investors.
A very small fraction. The vast majority is held by Japanese pension funds, Japanese banks, and the citizens themselves through savings. This insulates it from sudden foreign capital flight.
So you don't have a situation where, say, American or European hedge funds can suddenly dump Japanese bonds and trigger a crisis.
Exactly. It's a much more stable, closed loop.
And the second, and perhaps more important, reason involves the central bank, the Bank of Japan, or BOJ.
Correct. This is the linchpin. The second reason is that the BOJ has effectively become the primary buyer of Japanese government bonds, or JGBs.
What does that mean in practice?
Through years of unconventional monetary policy, You've heard the term quantitative easing. The BOJ has absorbed vast quantities of this debt onto its own balance sheet.
So they're essentially printing money to buy their own government's debt.
That's a simplified way to put it, yes. And by doing so, they've been able to keep interest rates, and thus, the government's borrowing costs, artificially low.
Oh, low.
Close to zero, for years. This is the extraordinary mechanism that has allowed Japan to sustain this level of spending without the debt collapsing under its own weight.
So the market's apprehension, then, is not just about the absolute size of the debt, which is already shocking. It's about the sustainability of the BOJ's role in managing it.
That's the real fear.
Because if this new inflation persists, the BOJ is eventually forced to raise interest rates, just like every other central bank.
They have to.
And that would fundamentally alter that unique debt dynamic you just described.
It would break the entire model. That is the core of the investor scrutiny. They are not questioning the need for economic relief. They get it.
Sure.
They are scrutinizing the long-term implications for the nation's credit profile. The key questions investors are asking are, how is the government funding this new over 20 trillion?
Where's the money coming from?
Is it purely through new bond issuance, which just increases the debt pressure? And critically, if inflation forces the BOJ to pull back from buying JGBs, what happens to Japan's borrowing costs? Who will buy all those bonds if the BOJ doesn't?
And if that perception of risk increases, or if a rating agency like Moody's or S&P suggests a downgrade,
Then those borrowing costs rise, and they could rise sharply.
and that would create a huge immediate drag on future economic growth. It could potentially consume the entire intended benefit of the stimulus in the first place.
It creates a vicious cycle. The interest payments alone on a debt load this size, even a modest 1% increase in rates, would require massive structural budget cuts or tax hikes just to service the debt.
Which would undermine the very purpose of the growth stimulus.
Completely. This highlights the acute fiscal conflict policymakers are facing. They have to choose. Prioritize short-term, immediate economic relief versus the critical existential need for long-term fiscal stability and debt reduction.
And with this package, they have decisively chosen relief now.
Relief now, and we'll figure out the bill later.
And what are the real-world immediate consequences if the markets decide that Japan has been fiscally imprudent with this package? What happens next?
Well, beyond the risk of higher borrowing costs, a loss of confidence can trigger currency depreciation, a weaker yen.
Which is already a problem.
And it makes those imported energy and food costs even more expensive, which directly fuels more inflation. It makes the initial problem worse.
So the solution could feed the problem.
It could. Furthermore, a sustained loss of investor trust makes it harder and more expensive to fund future growth or even to manage the existing debt. The stability the stimulus aims to achieve could be entirely undermined if the manner in which it is funded and managed exacerbates the debt crisis.
So the market is waiting.
The market is waiting for the fiscal consolidation plan. They want to see the exit strategy, not just the spending announcement itself.
That brings us squarely to assessment. This is a strategic gamble. So if we were sitting here a year or two from now analyzing the outcome, how would we judge whether this 20 trillion intervention actually paid off?
A crucial question.
What are the hard, measurable success criteria, the key performance indicators, the KPIs that economists and investors will be monitoring?
We have 4 primary indicators we must watch very closely. The first is the most fundamental: trends in household consumption and overall consumer spending.
Is the money being spent?
And how is it being spent? We need to look at the details. Is the spending going into durable goods like cars and appliances and discretionary items like travel, which suggests confidence?
Right.
Or is it merely being used to cover the basic higher costs of food and energy necessities?
So confidence versus survival.
Precisely. If consumption doesn't noticeably pick up in a broad-based way, or if it immediately stalls after the direct aid runs out, then the short-term goal failed to create the necessary momentum.
Okay, that's number one. The second indicator, I assume, relates directly to that strategic investment element, the supply-side transformation.
Exactly. That's capital expenditure, or CapEx, and general business investment.
So are companies investing in the future?
We need to see if SMEs and large corporations are actually taking advantage of the incentives and loans to modernize. Are they spending on AI implementation, on R&D for green energy projects?
As opposed to what?
As opposed to just stockpiling the cash out of caution or using it to service existing stagnant operations. If the investment is only defensive survival, the long-term strategic goal is missed entirely. We need to see proactive spending on future capacity.
Got it. The third KPI focuses on that immediate relief target we talked about, the survival of the SMEs themselves.
Yes, we'll be monitoring the survival rates and, more grimly, the insolvency figures for small and medium-sized enterprises.
Our business is going under.
The support is supposed to prevent widespread failures and mass unemployment. If corporate insolvencies remain high, or if we see a significant increase in the failure rate of younger, high-growth companies despite this capital injection, then the intended cushion was ineffective or misallocated.
And the final indicator brings us back to that core tension, that tightrope walk between deflation and inflation.
We need to see a disciplined inflation trajectory. Success, in this case, is not zero inflation.
All right, they want some inflation.
They want some. Success would mean inflation stabilizing at a manageable level, ideally consistent with the central bank's 2% target, without spiraling higher.
And the risk.
The risk is that if boosting demand causes the economy to overheat, or if the currency remains too weak, we get unsustainable inflation. And that risks needing aggressive monetary tightening.
Which means the BOJ would have to raise rates quickly.
And that could instantly choke off the capital investment and growth the stimulus was meant to create in the first place.
Such a delicate balance. Now, speaking of risks, let's systematically address the specific challenges and weaknesses analysts have broken down. Because this level of spending inevitably opens up multiple avenues for failure.
Absolutely. We can break it down into 4 major risks that policy watchers are actively discussing.
What's the first one?
The first, and most immediate, is that inflation risk we just touched on, the danger of overheating.
Pumping too much money in too fast.
The government is injecting massive demand into an economy that is still facing supply chain friction and those currency-driven import cost hikes. If supply, particularly high-skilled labor and domestic capacity, cannot keep pace with this demand injection,
The prices just go up.
domestic prices climb uncontrollably. This forces the central bank's hand, leading to those aggressive rate hikes that destabilize the debt dynamic we spent so much time on.
So that structural weakness in the debt dynamics leads us straight to the second, systemic risk.
The debt risk. We've established that the already high debt-to-GDP ratio is being compounded by this new spending.
Right.
This creates tangible credit rating risk. If international agencies signal alarm, borrowing costs rise, and the government's ability to use fiscal policy effectively in the future is severely hampered, this risk is the sword of Damocles hanging over all Japanese policy.
It's the one risk that affects everything else.
What is?
Now, the third risk is specific to the SME support component, and it's a fascinating economic phenomenon. The risk of propping up zombie companies.
This is a deep, deep structural challenge for Japan, and it has been for decades. A zombie company is a firm that, based on its operating profit, cannot generate enough revenue to even cover its interest payments.
So it's not viable on its own.
It survives only because of access to continuous cheap credit or government subsidies. They are economically dead but are politically or financially kept alive.
And the risk is that this stimulus money goes to them.
The support for SMEs, while necessary to prevent mass layoffs, risks propping up these inefficient companies that should, in a healthy economy, naturally fail.
And what's the consequence of that?
It ties up valuable capital, labor, and talent that could be used by innovative, high-growth firms.
So instead of clearing the field for a new dynamic AI or green energy startup to hire engineers and use capital,
The stimulus money might just ensure that an outdated regional manufacturer survives for another 2 or 3 unproductive years. It's economic friction.
it clogs the economic arteries.
It's one of the key reasons Japan's productivity growth has lagged for so long. The capital isn't flowing to where the returns are highest,
Which brings us to the fourth risk.
which is inefficient allocation risk.
This relates to those big strategic investments in tech and AI. Just because you have the money doesn't guarantee a good return on that investment.
Precisely. The potential for funds allocated to these strategic investments to be mismanaged, wasted on non-essential projects, or channeled inefficiently is a perpetual risk in any massive public spending program.
And Japan has a history here.
It has historical precedent here. The massive sums poured into previous technology pushes that failed to materialize into sustained global competitive advantage. If the bureaucratic execution is flawed, the long-term impact on global competitiveness and new job creation becomes highly uncertain.
So before we conclude, we have to reiterate that this is not a generic stimulus package. Japan's unique profile requires careful consideration, distinguishing it from general global efforts. What makes Japan so unique in this calculation?
There are 3 structural factors you always have to keep in mind with Japan. First, the unique demographic profile.
The aging population.
An aging population and a declining birth rate, which reduces the long-term tax base and the workforce size, making long-term debt servicing that much harder.
Okay, what's second?
Second, the persistent, deeply entrenched deflationary mindset. It is incredibly hard to convince consumers and businesses that inflation is real and permanent when they have spent 30 years expecting lower prices.
It's a psychological barrier.
A huge one. And third, its specific reliance on export industries and its vulnerability to currency fluctuations means that purely domestic demand injection efforts are harder to predict and control than in more domestically focused economies like the U.S.
So this is a highly tailored, structurally complex intervention designed for an economy that, in many ways, exists in its own financial universe.
It is. And the ultimate success will depend entirely on whether this package can successfully catalyze a fundamental shift towards dynamism and innovation, a move away from that deflationary mindset, rather than just providing a temporary, expensive boost that further balloons the national debt. So, to synthesize what we've explored, Japan's $20 trillion stimulus package is a bold, albeit incredibly complex, attempt to navigate the current severe economic headwinds,
Especially that recent inflation surge.
while strategically laying the groundwork for future prosperity in these key technological sectors.
It is a high-stakes, strategic gamble. It's designed to strike a near-impossible balance. You've got immediate, tangible relief for citizens struggling with costs on one side, and strategic supply-side investment in AI, digital transformation, and green energy for the next generation on the other.
It's an explicit attempt to use fiscal policy to jolt the economy out of its long-standing pattern of low growth and stagnation.
However, that long shadow of the significant national debt, we can't say it enough, already the highest among developed nations.
And sustained only by that unconventional central bank intervention.
It fuels considerable and completely justified market apprehension. This fiscal reality is the single greatest structural threat to the package's success.
It raises serious questions about Japan's long-term sustainability and creditworthiness, especially if inflation forces interest rates higher.
Therefore, the true measure of success for the stimulus will never be its headline figure of $135 billion alone. Its legacy will be defined by its ability to foster genuine, long-term economic transformation.
And that transformation hinges not just on the strategic allocation of funds, but on the disciplined execution of the spending, and crucially, the subsequent plan for debt reduction.
The plan they don't have yet.
The plan the market is waiting for.
So that brings us to the key takeaways for you, the listener, whether you run a business that operates in Asia or you manage global investments.
For businesses, the message from this seems clear. Leverage this support not for mere survival, avoid becoming one of those zombie companies, but for proactive innovation and adaptation into those high-potential, high-skilled sectors the government is so aggressively targeting.
Use it to pivot.
Exactly.
And for investors, vigilance regarding fiscal discipline is paramount. Watch those specific key indicators we mentioned, the detailed consumption trends, the capital expenditure in future tech, and that inflation trajectory.
Because any perceived misstep on the debt management side or a necessity for aggressive monetary tightening will likely negate the positive effects of this enormous spending push.
And finally, let's leave you with this final provocative thought to consider.
This massive spending package largely treats symptoms, inflation, depressed demand, sluggish innovation, with a capital injection.
It's medicine.
But what deeper fundamental structural reforms beyond temporary cash must Japan commit to in the coming 5 to 10 years to truly change its trajectory?
The ultimate test really lies in whether they can tackle politically difficult issues like labor market rigidity or potentially restrictive immigration policies to address the demographic crisis.
And corporate governance practices to incentivize risk-taking and capital efficiency rather than the risk aversion that's been the default for so long.
That commitment to fundamental structural surgery is what will ensure Japan's economic future is truly robust, dynamic, and most importantly, fiscally sound enough to handle the next inevitable global economic challenge.